What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined by Peter Schiff, President of EuroPacific Capital and the host of the Peter Schiff Show. Peter, it's good to see you.
Well, it's good to be seen and nice to see you, at least virtually.
Yeah. So you know what? We've had you on the show a bunch of times this year, but it was exactly a year ago that you were on stage at our physical event in Vancouver, Canada, where you entered into a second bet with Brent Johnson. The first bet was the previous year about interest rates. This year was about the dollar. And I think the dollar was like 96, the Dixie at that point a year ago. Now, clearly you're coming out on top, right? It's a year later, we're at like 90 today, right? You were betting the dollar would fall.
Yes.
I remember though, Brent was pushing for 18 months as a timeline, not 12. Do you think that would make any difference in the next 6 months, Peter?
Well, I think it would be hard for the dollar to recover back up to, I think it was 96.70, because I wrote it down in my phone so I would remember where it was. Now, I assumed that we would be back in Vancouver. I didn't realize at the time that we'd have COVID. But, I've been spending, the playoffs. Every time I've been going up there, it's been during the playoffs. And so now I don't have to take that long flight from Puerto Rico. So it's a lot easier. But I expect the dollar to be lower in 6 months than it is today. Whether or not Brent wants to double down on another bet. He paid off the first one. So I guess I can give him a chance again if he wants to go for a third time. I know he thinks the dollar is going to go up, but, I still think there's a lot of pressure on the dollar. Even more now than there was when we made the bet a year ago. So I'm not really sure how he thinks. He still believes that when there's a problem, everybody's going to come rushing into the dollar. But what if the dollar is the problem? Right? We have record trade deficits, we have record budget deficits, and none of those are going to get better now that Biden is coming in. And in fact, we just had the special elections in January, and now the Democrats have the Senate. So you have a Democratic Congress, a Democratic president. These guys are going to spend even more than Trump did. And Trump was a record spender and record borrower, cheerleader for money printing. And, certainly you're going to have an even bigger cheerleader now that Biden's there. His whole team, it's all about MMT and, free this and free that. And so I don't see how the dollar is going to rise in this environment. Look at what's happening to commodity prices across the board. You have commodities hitting 5-year highs, from the industrial metals like copper to the grains, corn, wheat, soybeans. Everything is going up, and it's not because we have this booming economy. We still have COVID. This is all inflation. It is money printing that is driving the increase in prices. I don't see how the dollar can thrive in an environment like that. And look at what's happening to interest rates. The 30-year Treasury is knocking on the door of 2%. And if the Fed lets it get through 2%, it can make a beeline for 3 or 4. And the over-leveraged economy can't handle that higher rate, even though historically it's still low. So the Fed is going to have to print as much money as necessary to artificially suppress long-term interest rates, which means massive creation of dollars to buy more treasuries. How do you get a stronger dollar when the supply of dollars is going to go through the roof? It's basic supply and demand. If you get a lot more dollars, those dollars don't become more valuable. They become less valuable.
I'm with you. Okay, so there's a bunch of stuff in there I want to unpack. And beginning, with the runoff in Georgia, Democrats taking the Senate. Biden's now going to get approval likely for his $400 billion clean energy stimulus, right? It's supposed to be distributed over the next 10 years. Do you think that's the whole picture, though? I was talking to E.B. Tucker yesterday. I mentioned the $400 billion promise towards clean energy, and he's like, that's just the appetizer. Get ready. It's going to be way bigger than that.
Yeah, look, what these guys don't realize, though, is that we're broke. We can't even afford to make good on the promises that we've already made, let alone the new ones that the Democrats have, already bribed the electorate with. And, look at what's happening to oil prices. Oil prices went above $53 a barrel yesterday. Who knows where they're going to be, soon. But I think the prices are headed much higher for oil. People are going to be very surprised, I think, by the oil price. But, the big difference, we had $100 a barrel oil years ago, but that's when the U.S. fracking boom was really going. And so we were producing a lot of our own oil. And so we didn't have to import as much. But I think that the next time oil hits $100 a barrel, which could happen this year, we're going to be importing record amounts. I mean, our industry is a shadow of what it was the last time oil was at 100, and it's not coming back. It's not like all of a sudden oil prices are going to go up and then we're going to start drilling again. A lot of money was lost by investors the last time because that oil was very expensive to get out of the ground. And so I don't think the investment community is going to, step up again, given how much they've already lost. Yeah. Plus, I think that it's very likely that the Biden administration is going to further increase the cost of domestic production with more regulation. So they don't like drilling, they don't like exploration, they don't like fracking anyway. And so it's going to get more expensive. And so our record trade deficits, right? And the trade deficit is at a record high, despite Donald Trump's promises when he campaigned. He is leaving the office with a trade deficit much higher than when he took office. I mean, it's record in goods. It's all-time record highs. Yeah. And I think it's going to soar when we have to pay for $100 oil to import. And so that's just going to put more downward pressure on the dollar as it puts upward pressure on trade deficits and interest rates.
Right. How much how much will the oil price be impacted, Peter, when we're allowed to travel again? Like, do you think there's a lot of pent up demand right now, recreational business travel? That's just, we can't go anywhere, right? But that demand hasn't left. I mean, I'm happy to stay at home, but a lot of people aren't.
Obviously, as more people travel, the demand for energy will pick up, and I think people will return to traveling. I think it may be a more gradual return than people expect. But remember, there's also been a big reduction in supply, and so you have two sides of the equation to determine price. And so if supply has gone down more than demand, prices can still go up. And I think that's what's going to happen. And of course, if the dollar continues to fall, which is what I believe will happen, that increases demand for oil outside the United States, not necessarily for travel, but for other things. And it certainly is possible that the rest of the world could start traveling long before Americans do.
Okay, so I know another trade you're watching and participating in is the emerging markets trade. Talk to me about the relationship between a falling dollar and the emerging markets trade, Peter.
Yeah, a weak dollar is the best thing that could happen to the emerging markets because it was a strong dollar that was so detrimental. Yeah, I just got a phone ring and I forgot to put it on mute.
No worries.
I don't know if you guys,
Go ahead. It's all good, man.
Okay. So it's the strong dollar that was hurting emerging markets because a lot of the emerging market companies have U.S. dollar denominated debt. And as the dollar strengthens, that made it harder to service the debt, certainly harder to repay it. It would put downward pressure on their currencies, which might put upward pressure on domestic inflation rates, which might force central banks to have to raise rates, even if the economy was weak, in order to, support their currency and fight inflation. So the strong dollar was a major headwind. The weak dollar is a reversal of all that. It becomes a huge tailwind for the emerging markets because now all of their dollar-denominated debt becomes easier to service and cheaper to repay. Yeah. And if commodities go up and if they're exporting commodities, then their terms of trade improves. And of course, as their currencies start to rise, now emerging markets look more attractive to global investors who want to participate in those strengthening currencies. And so the money flows into those markets. And why I think the emerging markets are going to be particularly strong this time is because if you go back to the last time there was a lot of money flowing into the emerging markets when there was a weak dollar, a lot of these emerging market governments and central banks were worried that their currencies were getting too strong. And, they had the currency war. Everybody was worried that they would somehow lose a competitive edge in exporting to the U.S. And so they were trying to fight the rise in currencies. I don't think they're going to do that this time. I think these emerging markets are going to be happy to see the U.S. dollar decline. The same thing with China. I mean, look at some of the moves we've seen recently in the Chinese RMB. I mean, we've seen some big moves for that currency as the U.S. dollar is sinking against the yuan. And I think if the Chinese monetary authorities are content to allow the yuan to appreciate, then that's going to take a lot of the pressure off the other Asian economies and central banks to try to prevent their currencies from rising. As long as the yuan is rising too, they're not going to necessarily feel threatened. So, and this was a big demand for our bonds, because when you had all these emerging markets intervening and buying up dollars and selling their own currencies, they would invest those dollars in U.S. treasuries, and that was helping us finance our deficits. Well, now the deficits are going to go through the roof, but you're not going to see Asian central banks buying U.S. treasuries. In fact, I think they're going to be looking to unload the treasuries that they already have. So the whole world is going to try to get out of U.S. treasuries, and that leaves the Federal Reserve as the only buyer. But the Fed can only buy if it prints money, and now it's adding to the supply of a currency that people already don't want. And so it's, adding fuel to a fire, and the dollar is just going to burn to a crisp.
Right. Okay. So I want to get a little bit more granular with the emerging markets angle, because, I'm really wondering, Peter, my question is, how do you play it? There's some ETFs. I know you have a fund. You have the emerging markets small companies fund. So maybe let's start with that. What's in the fund in terms of where and what you're buying? Yeah.
So my fund is the emerging market small companies, and it's overweight in Asia. Because I think it's the emerging markets in that part of the world that, will benefit the most. I think those economies are in the best shape. They generally have lower taxes, fewer regulations, bigger trade surpluses. But the emerging economy is going to benefit, because if you look at who has been financing U.S. deficits, they've been doing the heavy lifting. And so it's the emerging economies and the consumers in those markets that have lived beneath their means to enable Americans to live above theirs, because we consume without producing, but they produce without consuming. We borrow without saving, and they save without borrowing. And so what's going to happen when the world stops lending us money and diverting their production to us, these countries are going to keep more of what they save to invest domestically, and they're going to consume more of what they produce. Rather than trading their production for our paper, they're going to enjoy that production. And so those economies are going to prosper. Their living standards are going to rise. But America is going to suffer. I mean, Americans are going to have to do without things that, they were taking for granted, because we don't produce the things that we consume. We rely on, in many cases, the emerging markets to do that. So I think these markets are going to be particularly strong, but also those that have a lot of natural resources. I think you're going to see a real boom. What's happening right now in these industrial metals and agricultural commodities, this is just the beginning of a major, major bull market in commodities. And certainly countries that have these resources in abundance and can export them will benefit.
Okay. Now, just to help me understand investor sentiment from your seat right now, because you have precious metals and gold funds and this emerging markets fund. Now, I'm hearing people like yourself and Frank Holmes and Raoul Paul talk about the emerging markets trade, but you guys are on the front. You're in the front seat. I mean, you're generally the first to move. When we're looking at retail money, though, I guess my question is, Peter, are you seeing more inflows right now into your emerging markets fund or your metals funds?
Well, this year we've had quite a few inflows into the gold fund. I mean, so the gold fund has, and most of the money came in earlier in the year. That's where it all came in early in COVID. But in the scheme of things, it's still small. If you look at, where all the money is, very little of it is going into gold. I mean, there's not even that many gold funds. I think there's only about 60 of them or something like that. I mean, So it's a small universe that investors have to choose from. So I think, this is just the tip of an iceberg. I think the big wave of retail money or institutional money coming into the sector is yet to come. And I think it's going to happen. I think right now people are still in denial. I think people are still chasing the momentum stocks, these high-flying NASDAQ stocks, and a lot of companies that have a great story, right? It's all sizzle, but no steak. But what you have in the emerging markets and in mining and precious metals, it's steak. I mean, there's a lot of substance behind the story. It's just that a lot of people don't understand it yet, don't realize how this is going to play out. They're still bullish on the U.S. economy. They still think everything is great. They still have faith in central bankers. But that faith is going to be challenged in the years ahead. And people are going to be looking for alternatives to, what was working in the decade where the bubble was inflating. It's a completely different story as the air comes out. Okay.
Now, you've been talking about this decoupling thesis for a while, right? We kind of touched on this, the decoupling of foreign markets from the U.S. Markets, and the decoupling of gold equities from the general market. So let's focus on that one a little bit. What does that mean, Peter, to have the gold stocks decouple from the general market?
Well, gold stocks decoupling would mean that gold stocks can keep going up even as the overall stock market is going down. And I would expect that to eventually happen, because I think that gold could rise as stocks fall. But, the thing that's driving everything right now is central banks, and in particular the Fed. The Fed is printing money. So it's inflation that's making the price of everything go up. But when you have a stock market that's driven by inflation, as opposed to one driven by, earnings, economic growth, that's an environment that's much better for gold than gold stocks. Because in an inflationary environment where commodity prices are rising, and gold would be a commodity, but gold is also a very special commodity in that it's an excellent store of value to preserve purchasing power, because it's a lot easier to store gold than oil or wheat or soybeans. And so once you get into an inflationary environment and people looking to preserve purchasing power, they're going to rush to gold. And so the gold mining stocks are going to see a huge increase in their profits. And so this is a great environment for those companies. But I think we're already seeing a bit of a decoupling, and it's going to get bigger, I think, as the year progresses, between the U.S. stock market, like the S&P 500, and global stocks. I can already see that if you look at the stocks that we own in our separately managed accounts or in our mutual funds, excluding the gold stocks, our non-gold stocks are dramatically outperforming the S&P so far this year. And you can see that almost on a daily basis, stocks going up, especially stocks that we've been buying, these value stocks where people have been focusing on growth and ignoring value. Now the value stocks are quietly coming back into vogue. And a lot of the resource companies, the agricultural companies or the industrial mining companies are making 52-week highs now. And they're way outperforming the S&P. So I think we've already seen that. Now, the question is, can these stocks continue to go up if the U.S. market really tanks, right? Because the U.S. market's really been going sideways. So it's not a complete decoupling, but it is an outperformance. And I do think that if the U.S. market crashes, then, on the day that happens, obviously a lot of stocks are going to go down in sympathy. But I do think that 2021 can be a down year for U.S. stocks and a very strong year for foreign stocks, over the entirety of the year, even if they, there can be certain days where they're going to move together. Yeah. But I think there will be a decoupling in the overall direction. And if the U.S., if there's enough inflation, obviously, in nominal terms, U.S. stock prices can rise. But I think they would rise far more slowly than would foreign stocks, especially pricing them in dollars.
Okay. Yeah, I'm with you. I mean, everything you say, I agree with in terms of the macro setup that's leading to this yeah, sure, decoupling of gold stocks in the market, but nothing is operating rationally right now, And so although it makes logical sense, what's it going to take? And I guess a follow-up question to this is we're seeing this massive influx of retail money enter the market on the back of, the Robinhood and all the discount brokerage firms. Why has this money, Peter, ignored the commodities sector so far?
Well, I mean, I know obviously all the money hasn't ignored it. Commodity prices are very, very strong. Sure. But I think in general, people trade in the rearview mirror, and the commodity story is new. The NASDAQ, social media. I mean, this story has been there. And I think the public invests in the rearview mirror, not looking through the windshield. So it doesn't surprise me that retail investors, haven't caught on to what's happening or, how things are about to change. But, what's irrational right now, I mean, obviously wanting to get out of U.S. currency makes perfect sense, right? So the fact that people are looking for other assets, because the U.S. dollar is a guaranteed loser. I mean, the Federal Reserve has told you this, right? We want 2% inflation every year. And of course, they're going to get a lot more than 2%. But we had an inflation problem when the goal was price stability. When the Fed was promising stable prices were going up. But now that they're promising that prices are going to go up, imagine how much higher they're really going to go up when this is actually their goal. So the Fed is telling you, you're an idiot if you hold on to dollars. I mean, either spend them now and buy something, because if you hold on to them, whatever you want to buy is going to cost you more in the future. Okay. But if you don't spend them, then you got to find a place to store them. And so there are people, they're buying stocks. But they need to realize that there are much better stocks to own than the overpriced stocks that dominate the U.S. market. And I think right now, investors are still reading from an old playbook, because as interest rates are rising, the natural tendency of traders is to think that this is a bearish development for gold, because typically when rates are going up, the Fed is now raising rates. That's been a headwind for gold. But what the market has to understand is that it's very different now, because the Fed is not going to respond to rising market interest rates by raising short-term rates, right? They're not going to respond to an uptick in inflation by trying to fight it by tightening monetary policy. In fact, it's going to be the reverse. What the Fed is going to do in response to rising interest rates is print even more money, because long-term interest rates are rising because inflation premiums are rising, because the market is sensing more inflation, and so they want to build in a larger premium into the bond market. But the Federal Reserve, because it has created this massive bubble and encouraged so much debt, the Fed cannot allow the market to raise rates, because indebted American companies and the overly indebted U.S. government won't be able to afford to service its debts if rates go up. So instead of trying to fight the increase in inflation, the Fed is going to stoke the fire. The Fed is going to respond to a increase in long-term rates by printing even more money, and then using that money to buy long-term bonds to artificially suppress their price. And so instead of fighting inflation, the Fed adds to the inflation problem. And now whatever inflation was causing people to sell treasuries, it's now gotten worse. The Fed is making the inflation problem worse as it responds to the rising interest rates that are a manifestation of those fears. Right. So this is not what we had in the past. So investors have to realize that the higher inflation goes now, the higher it's going to go in the future. The Fed is not going to fight it. The Fed is going to surrender to it and basically fight fire with fire. The more inflation we get, the more inflation the Fed's going to create. And this is an environment that we've never seen in the United States for gold. And it's going to ignite the biggest bull market we've ever had.
Okay, I love it. Now I want to take it down to Main Street for a second, Peter. We talked a lot about rising inflation. I'm curious to get your thoughts on how much that is a contributing factor to call it the rise of populism on both the extreme left and the extreme right, civil unrest, and everything we've been seeing. I mean, I'm not American, so I'm an outsider looking in. But how much are these underlying factors contributing to people's unrest right now?
Well, first of all, I don't even know, there's no real extreme right anymore. I mean, the extreme left is socialism. And if that's the case, the extreme right would be, free market, libertarian, laissez-faire, stuff like that. And, Trump was kind of in the middle and he leaned left. He wasn't even, as far as I'm concerned, on the right side of the political spectrum, if you're going to put socialism on the far left. But he was a populist, but he believed in big government and he wanted to pay for it by printing money. He wanted to run deficits, but he didn't want to raise taxes to fund government spending. He wants to print money. And so the left is, certainly wants to do that too. I mean, look at how Donald Trump went out. The last thing he did was threaten to veto a spending bill because it didn't spend enough. He didn't want the government to mail out $600 checks. He demanded $2,000 checks. Right. And of course, the Democrats are more than happy to oblige, and they forced the Republicans to be the bad guys standing in the way of all this free money. But we're just going to move even further to the left. And I think because Donald Trump led the Republican Party to the left, he enabled the Democratic Party to go further left without being out of the mainstream. I mean, Trump actually helped to bring socialism into the mainstream of American politics by taking the Republican Party so far left. He gave the Democrats that room to maneuver. And yeah, I mean, the inclination as soon as they get in there is going to be to have all of this free government and just pay for it by printing money. Now, yes, I mean, there are going to be tax hikes on the rich. I mean, no question about it. That's happening. But those tax hikes on the rich are not going to raise anywhere near the amount of revenue that is going to be required to pay for all the spending. Mm-hmm. So even though the government's going to raise taxes, the deficits are going to get much, much bigger. But the real tax that everybody is going to be hit with is the inflation tax, because all government spending needs to be paid for. And, the politicians can pretend we're getting it for free, but we're not. When they print money and spend it, they are taking our purchasing power. They are destroying the value of the dollar. They are causing prices to go up. And those price increases are tax increases. Because government doesn't have any wealth. Anything it spends, it must take from the private sector. And so if it doesn't do it honestly through taxation, it does it dishonestly through inflation. And so Americans are about to pay the most onerous inflation tax ever paid by any generation of Americans. And, my goal is to try to help people avoid that tax to the greatest degree possible. And the only way to avoid it is to get out of what's being taxed. Inflation taxes your dollars and any of your investments that are denominated in dollars. So if you don't want to pay that tax, get out of the dollar now before it goes down in value and you get into these foreign assets, gold, emerging markets like we discussed, foreign markets, foreign currencies, anything that is outside the US dollar.
Okay. Awesome, Peter. Look, I've used up my time. I think that's a good place to cap it. Thanks so much for coming back on.
Oh, my pleasure.